Hey everyone, Douglas here, and welcome back to the MMT Macro Trader in this market recap for Monday, July 3rd, 2023. Listen, I am literally heading out the door in just a minute to go to the Northern Command, our cottage up in Northern Michigan, for the week, and I need to get a market recap posted. So what I did is I cut out the first 10 minutes of today's market update that I post over on the Patreon page. I thought the points I made were worth sharing for everyone. Listen, we are in unprecedented territory. That's what I lay out. So I'm going to clip to myself from earlier this morning during the update. Let you guys watch that for today. Get what you can out of it. I'll see you in just a second. Hey everyone, Douglas here, and welcome back to the MMT Macro Trader and this macro update for Monday, July 3rd, 2023. It's 12:06 p.m. Eastern Time as we get things underway for today's update. Stocks, once again, are firing higher. Last week, we were looking for a resumption of the bullish trend. Of course, mid-June, we had options expiration. We knew there might be a pause in the rally, that window of opportunity for volatility to kick up. We saw that. We saw the brief pullback, but we knew the flows were strong. We were looking at the gamma data, the gamma exposure distribution. We knew that 4350 zone would likely be support, and we fired higher from there. So all systems go once again. Things are looking strong. We'll look at the data. Even the data continues to strengthen for that. So this bullish rally still seems like it is still very much just underway and has another leg or two in it on the shot higher. I was putting together a video this weekend. I'll get it out maybe later this week or the week following. It's going to be a video response to Bob Murphy and kind of the Austrian school and why we are not getting a recession following the mean reversion. The inversion of the yield curve. While I was putting together that video, something clicked, and I kind of want to sit on this point for just a second. Something clicked that I think I've intuitively known. I see the data, but something finally pieced together really just how unprecedented the situation that we are in. And it really goes down to the fact that in 2022, we were very close to a crisis. We saw the fiscal data fall off, the year-over-year change in deficit spending completely fall off in 2022. Levels not seen before the dot-com bubble, really. We were at levels that created enough of an instability in the fiscal side that we easily could have gotten into a recession in 2022. Of course, we accelerated out of that, and now we are in the situation that we are in, where we are seeing massive acceleration, almost economy-wide here in various metrics, and obviously stocks are following suit. But what kind of hit me is that normally we would have had an economic slowdown, a true economic slowdown, a recessionary economic slowdown in 2022, and the Fed would have read this signal to go ahead and lower interest rates. And I think had they done that, we actually would have been in recession at this point. But because what preceded the fiscal slowdown in 2022 was the energy shock that we saw from the invasion of Ukraine from Russia, that kept the Fed with their foot on the gas on the interest rates. Now, the Fed obviously thinks they're slowing the economy down. Heck, even the market thought this would slow the economy down. But we know that the Fed is just adding interest income, increasing the term structure of prices, speeding up the turnover of money in the economy, right? We know that is expansionary, not contractionary. And so normally the Fed would drop interest rates to zero, remove all the additional interest income, the flow. It would shut that flow off. It would slow the turnover rate of money in the economy, and it would flatten out the term structure of prices. In an economy that's already contracting, that is enough to send it over the edge, to start the cascading effects that create a recession, that create runaway unemployment. But that never happened because the Fed saw this inflationary signal of oil pushing higher in February from the invasion of Ukraine by Russia. It saw unemployment still very strong, and it said, nope, we're going to go ahead and keep rates high to dampen demand. Of course, they had that backwards. So what I'm saying is we skipped the recession that should have been because the Fed doesn't understand how its policy actually works, what the implications are. So we skipped the potential fiscal downfall, right? And then immediately we reversed course. By June, we were starting to turn the corner, and by October, November, December, we were re-accelerating on the fiscal side. The other thing that happened, right? Usually it's fiscal, then the banking sector, then the banking cycle, the endogenous cycle rolls over. To a certain extent, we saw that. We saw that again into about December up until now, really March, right? We haven't started to see the banking side of things, the endogenous cycle really start to pick up until this point. And here's the thing that kind of clicked. We've never had a situation where both the banking cycle is accelerating, beginning to accelerate, and the fiscal side is also accelerating at the same time. Usually what happens is by this point, you get the pop in fiscal after some sort of recessionary event, and that's beginning to fade away at this point. Employment's picking up, that sort of thing, right? You're starting to get just kind of what we would call the normal business cycle taking over, and the fiscal is slowly fading. But this time, the fiscal continues to accelerate. And what ends up taking over in normal times is the business cycle, the endogenous cycle. It's going to take over. It's going to produce. It's going to start, outweighing the growth in terms of the total growth, and it's going to produce its larger share, right? And then the cycle continues. That's not happening this time. It's different this time. It's so different this time. It's so unprecedented. Obviously, the last 3 years has all been unprecedented. But we missed the recession in 2022 because the Fed has the interest rate thing backwards, and now we're getting both engines to fire at the exact same time. We're getting the fiscal engine firing, and we're getting the banking side to fire. I say all this just to say that I don't have the slightest clue what's going to happen next, beyond the fact that we've never seen this, and we're starting to see flows hit out of both engines at the exact same time, accelerating. Listen, I'm geeked for what's to come from an MMT standpoint, just because we get to observe what the hell is going to play out next. And two, I'm pumped because this looks incredibly bullish. And at this point, I don't see, short of oil spiking dramatically higher, I don't see how this ends. I don't see how the Fed decides that I'm going to take the foot off the gas here. They're going to continue to see signals that they need to continue to hike rates at an increasing pace here. So I wanted to at least express that we are in very unprecedented waters here, right? Uncharted waters here. It's a very unprecedented time, and at this point, it's the bullish surprise I can only imagine should continue at this point. So, all right, that's what I have for today's update. Listen, if you're an active trader, active investor, you want access to the analysis, to the data, to the research, to the models that we've created through an applied MMT lens, make sure you check us out over at patreon.com/MMT Macro Trader. That's where you can get access to everything, multiple updates each week over there. We continue to grow. Join us, patreon.com/MMT Macro Trader. But that's all I have for today. So until next time, everyone, good trading, and we'll talk to you then. Bye-bye.